Hey there viewers, so I know you have been hearing a lot about bonds lately. But big question is, should they be a part of your investment portfolio? Should you put your hard-earned money in bonds, or is that just too safe? Well, let's talk about it. Grab your coffee and let's dive in. Alright, let's break this down. Imagine this. You lend your money to a friend and in return, they promise to pay you back with a little extra as a thank you for trusting them. That's essentially what a bond is. It's a contract where you, the lender, lend money to a borrower. Could be a company or a government, and in return they pay you interest. Simple enough, right? You give the money, they give it back with interest. Boom, that's bond for you. Now you are probably wondering, okay, but how does this actually make me money? Well, here's the deal. The bond market is where organizations like a big government or big corporations raise money. They take out loans from investors like you and pay interest over time. This means for a fixed period, you are going to get that sweet, predictable income, interest payments on a regular basis. It's like having a steady stream of cash flow into your account while you kick back and relax. Okay, now let's talk about two big categories of bonds, listed and unlisted. Listed bonds are like those high school friends you have known forever. They are easy, reliable, and can be traded on exchanges. These are government bonds or G-Secs and big company bonds or corporate bonds. These are your safer bets with lots of transparency and liquidity. But unlisted bonds, these are the wild ones. They are not traded on exchanges and often come with higher yields, which sounds pretty exciting, right? But here's the thing, these bonds come with a bit more risk. They are like that cousin who you know can be a lot of fun, but might drag you into a risky situation. It's a trade-off, higher potential returns, but more risk. You need to be comfortable with that if you are going down this road. Now you might be asking, okay, but are bonds actually safe? And here's the thing, no investment is 100% safe, but bonds are generally a lot safer than the roller coaster rides of the stock market. For example, government bonds like G-Secs are practically as safe as it gets, thanks to the government's backing. Corporate bonds can be a bit riskier depending on the company's financial health, but they are still more predictable than stocks. Let's quickly clear up a common misconception, bonds versus equities. Now, equities, aka stocks, are all about ownership and high returns, but they can also lead to some serious roller coaster movements when the market's not behaving well. Bonds, on the other hand, are more like a steady, reliable friend who will show up on time for every hangout, giving you those regular interest payments. Sure, bonds might not give you the huge potential upside like stocks do, but they bring safety, stability, and predictability in your portfolio. Now that we have got the basics down, let's take a quick look at different types of bonds you can find in India. We have got government bonds, corporate bonds, municipal bonds, and foreign currency bonds. Government bonds are pretty much the safest bet, like a solid friend you can count on. Corporate bonds, though, can vary. Some companies are rock solid and others may not be so much. Municipal bonds come with their own perks like tax benefits, and foreign currency bonds lets you dip your toe in international waters. The key is diversification. Don't put all your eggs in one basket. So, why should bond be a part of your portfolio? Well, let me give you 5 reasons. First up, capital preservation. Bonds help protect your investment. You get your principal back when the bond matures. Second, they are great for diversification. While the stocks can go up or down, bonds tend to stay steady, which balances out the risk. Third, regular income. Bonds pay you interest, like a paycheck that keeps coming in. Fourth is capital appreciation. If you play your cards right, bond prices can go up too, especially when the interest rates go down. And fifth, during a slowdown, bonds can be your go-to option. When the economy is struggling, bonds tend to do well since they offer predictable returns, unlike stocks which might take a dip. So, should bonds be your investment portfolio? Well, if you are looking for something stable, predictable, and a good counterbalance to your riskier investments like stocks, then yes, bonds should absolutely find a spot in your portfolio. They help you grow your wealth with steady income and low risk. But remember to consult your financial advisor before investing in bonds. So, if you think that this video has helped you understand bonds and bonds market, then don't forget to like, subscribe, and hit the bell icon for more fun and informative videos for smart investing. Catch you in the next one, folks.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.